Hello everyone, welcome to the weekly lecture videos. You may be aware that in the last two videos, we have learned how to calculate cost of equity, cost of debt, and cost of preferred shares. So since now we know how to estimate the cost of individual component, so we are in a position to calculate the overall cost of capital. Okay, so overall cost of capital essentially is the overall return that a firm must earn on its existing assets. Okay, or this is the overall rate of return the shareholders will want from their investment. Okay, or all the capital providers altogether will want from their investment in the company. Okay, now as far as the overall cost of capital is concerned, you see there are different components. Okay, that's why we need the weights of each of the components. We need to consider the weights of each of the component to calculate the overall cost of capital. That's why we call it weighted average cost of capital, because we consider the weights of individual component when we calculate the overall cost of capital. Since there are different components, now we need to worry about a specific mix. Okay, so a specific mix means the specific mixture of the firm's debt and equity. Okay, we will use the symbol E for equity. Um, Equity, which stands for the market value of firm's equity. And we calculate this by taking the number of shares outstanding multiplied by its price per share. Okay, so you see these equations. So value of a firm should be equal to the market value of equity and the market value of debt. So E stands for market value of equity, which is the number of outstanding share multiplied by price per share. And D stands for the market value of debt. Okay, market value of debt, where the market value of debt is number of bonds outstanding divided by the bond price. Okay. And finally, we will use V to indicate the combined value of debt and equity. Okay, so this is also known as the value of the firm. Okay. Now look, as we have debt and equity in the total capital structure, so we can calculate the proportion of debt and equity as this. So you see the proportion of equity should be the value of equity divided by total value, and proportion of debt should be the value of debt divided by the total value. So this will give us a percentage financed by equity and percentage financed by debt. Now let's talk about the taxes and the weighted average cost of capital in a classical tax system. Okay. Recall that we were always concerned with the after-tax cash flow of the firm when we learned about capital budgeting. If we are determining the discount rate appropriate to those cash flows, then the discount rate also need to be expressed on an after-tax basis. Okay. So let's look at the classical tax system, where most of the finance theory in the area of weighted average cost of capital has been developed. And then we will look at the imputation system that is applicable to countries like Australia and New Zealand. As we discussed previously in various videos or in various weeks, the interest paid by a corporation is deductible for tax purposes. Okay. Payment to the shareholders, for example, dividends, however, are not deductible under a classical tax system. What this means effectively is that the government pays some of the interest for the firm. Okay, so thus in determining an after-tax discount rate, we need to distinguish between pre-tax and after-tax cost of debt. Okay, so and you can see that after-tax cost of debt is cost of debt into 1 minus tax rate. Okay, so when you are paying a cost of debt, for example, 10%, due to the tax deductibility, your after-tax cost of debt will decrease. Okay, so that is called the tax deductibility or the tax advantage or the tax benefit. Okay, so for example, if your cost of debt is 9% and tax rate is 30%, so 1 minus 0.3, so your after-tax cost of debt will be 6.3%. Okay, so although you are paying 9% interest, but since that reduces your taxable income, that reduces your taxes, so your actual cost of debt is 6.3%. Okay, so that's how we calculate after-tax cost of debt in a classical tax system. Now, considering this, how do we calculate weighted average cost of capital? So you see that weighted average cost of capital is the cost of equity and cost of debt. Okay, so these two parts are consistent. Only difference is this tax component is multiplied with the debt part, because as we already discussed, that interest is tax deductible, not dividends. Okay, so that's one way to calculate weighted average cost of capital when you have debt and equity, and this equity is only ordinary equity. However, sometimes you may have both ordinary equity and preferred equity. So in that case, this is the cost of ordinary equity, this is cost of preferred equity, and this is cost of debt, and again multiplied by the tax component. And each of the individual cost component is multiplied by their weights. Okay, and as we sum them up, we get the overall or the weighted average cost of capital. Sorry. Look at this example. The Brumby Forests Group has 1.4 million shares outstanding. The shares currently sell for $20 each. The firm's debt is publicly traded and was recently quoted at 93% of face value. The debt has a total face value of 5 million and its currently priced to yield is 11%. The risk-free rate is 8%. The market risk premium is 7%, and you have estimated that Brumby Forest equity has a beta of 0.74. If the corporate tax rate is 30%, what is the weighted average cost of capital? Okay, so first of all, let's calculate cost of equity. Okay, cost of equity, and in this case, cost of equity has been calculated using the SML equation. We have learned it previously, how SML equation is used to calculate cost of equity. So you have this risk-free rate, which is 8%. Then you have risk premium, which is 7%, and risk premium is multiplied by the beta. Beta is 0.74, so cost of equity is 13.18%. And since there are two components, we also need to calculate their weights. Okay, weights. So you know that the current price of the share is 20, and there are 1.4 million shares. So this is the total market value of equity. And the debt is there are $5 million is the face value. Total face value of the debt is 5 million, but they are currently selling at 93%. So that's the total value of the debt. So this is total value of equity and total value of debt. And if we sum them up, we get the total value of debt and equity, and equity divided by total value will give us a percentage, which is 85.76%, and debt divided by total value, that will give us about 14.24%. Okay, and this 13.18, that is cost of equity already calculated, and cost of debt is also 11%, that is given, and we multiply the after-tax component here, and finally we see that weighted average cost of capital is 12.4%. Okay, so to remember, you need to calculate cost of equity using either Gordon growth model or a dividend growth model or the SML equation. Then you need to calculate cost of debt. You need to calculate the weights of debt and equity, and finally you put all this information together in the weighted average cost of capital formula. Okay. Now let's talk about the taxes and what in a imputation tax system. Remember that under these imputation tax systems, some of the tax paid by the companies effectively returned to the shareholders, as a tax credit attached to the dividends. We discussed this point earlier, right? The extent of the company tax returned in this way is depending on a number of factors, such as the company paying sufficient dividends to distribute all of its franking credits. Franking credits means issuing tax credits equal to the company tax paid, and these dividends being paid to entities that pay tax domestically. Okay. You might already remember the weighted average cost of capital formula in a classical tax system, right? Now, researchers have proposed a number of ways to take imputation system into account when calculating weighted average cost of capital under an imputation tax system. Okay. It is important that these approaches to work out the value of the franking credit to the shareholders, noting that non-resident shareholders cannot take advantage of franking credit. So for those shareholders, the franking credit is worth nothing. Okay. As all our capital budgeting examples in Chapter 8 and Chapter 9 are undertaken on an after-tax basis, the simplest way to incorporate the impact of imputation tax system is to alter the cost of equity to take into account the value of franking credit to the shareholders. Okay, for example, if the dividend growth model is used to obtain the required rate of return on equity, then the value of the dividend used in calculating is paid from after-tax profit of the firm before taking into account the value of the franking credit to shareholders. Okay. The important point to remember is that both the calculations for weighted average cost of capital and the NPV cash flows are done on an after-tax but before personal tax basis. Okay. Under an imputation tax system, the dividend in the hands of the domestic shareholders is increased by the value of the tax paid by the company on its profit. This tax payment by the company gives rise to what is known as franking credit, which represents a prepayment of tax for resident shareholder. Assuming 100% franking credit, the dividend will be increased by the value of the company tax paid on the dividend to the shareholder. Therefore, the dividend is actually worth more to a resident shareholder because of the franking credit, and that has been ignored in our calculation in cost of equity earlier. Okay, so in order to adjust for this, the required rate of return on equity has to be reduced by the value of the company tax. Okay, since shareholders dividend increases, so cost of equity should decrease by the taxes. However, not all shareholders are resident for Australia and New Zealand and therefore cannot take advantage of franking credit. Okay, so it has been said that the value of the franking credit to the shareholder should be equal to a factor, and equal to a factor which is equal to 0 when there is franking credit doesn't have any value to the shareholder. If the shareholder can make full use of franking credit, then the factor gamma should be equal to 1. Okay. The important point of all this is that the value of gamma will be determined at the shareholder level and the tax circumstances of each shareholder. Okay. For example, each dollar dividend is worth more than $1 because franking credits. Therefore, the dividend dollar should be grossed up by the company tax rate. The grossed up dividend is actually equal to the dividend divided by 1 minus tax rate, and then this has to be adjusted for the value of the franking credit to the shareholder gamma. Okay, so adjusted weighted average cost of capital is this. You can see previously we just had the cost of equity multiplied by its weight. Now we multiply it by 1 minus tax rate and then again divide by 1 minus tax rate into 1 minus growth rate. Okay, so these adjustments assume all shares can take advantage of tax credits. So this is the summary of capital cost calculation. So this is cost of equity, dividend growth, and SML approach, cost of debt, then weighted average cost of capital in classical tax system, and weighted average cost of capital in imputation tax system. So at a glance, these are all the equations, the approaches to calculate the cost of capital. Okay, so that concludes our discussion on cost of capital. In the next video, we will be talking about some pitfalls associated with cost of capital calculation. Thank you very much.